10 strategies used in crypto trading. Trading cryptocurrencies can be a daunting task for many traders. Cryptocurrencies tend to exhibit higher intensity than many other financial markets, thereby requiring a greater level of skill to trade short time frames successfully. As we navigate this dynamic landscape, we want to equip ourselves with the most effective strategies to maximize our gains and minimize risk. In today's episode, we'll crack down into the realm of crypto day trading and present the different strategies we can employ as traders to achieve our goals, which are profit. Therefore, without further ado, let's delve into it. Crypto day trading. Have you heard of this term before? We're sure many of you haven't, or most of you have heard of it but just chose to ignore it because it's not very important. Yes, while it might appear as a normal term, it's very important for any trader, especially those who are beginners in the trading arena in crypto. It's usually defined by traders' expectation of entering and exiting a trade within the same day. Therefore, being able to interact with intraday price dynamics is critical. How a trader engages the market during the time horizon will depend on the strategy deployed. We are very sure that one of the first questions you'll always have to ask yourself before proceeding to trade is, which cryptocurrency trading strategy should I use? You know, just like stocks, there are plenty of different trading strategies available to invest. But remember, each one will always have its own pros and cons. On the other hand, active trading strategies provide a level of excitement that many investors crave. Those active strategies come with their fair share of risk. A long-term passive investing strategy might be more appropriate for most investors. Cryptocurrencies differ from traditional currencies, or you can call them fiat currencies, like the US dollar or European euro, because they aren't produced and distributed by governments or the central banks that they control. Instead, cryptocurrencies are totally decentralized. When we talk about decentralized, what we mean is they can't be regulated by politicians, and they aren't affected by common monetary issues like inflation, for example. It's also worth noting here, there are no physical coins that you can hand over to a cashier in a retail store. Instead, cryptocurrencies are online-only assets that are normally kept in digital wallets. But to keep cryptocurrency networks secure and transparent, balances are recorded in public ledgers that everybody in the world can access. That means all crypto transactions are verified through a computing process known as mining and then recorded on the currency's ledger. In terms of value and the best cryptocurrencies to invest in, it's worth noting that a lot of crypto assets tend to fluctuate in value. Unlike fiat currencies, the value of cryptocurrencies is not decided by a central bank or the federal government. Instead, networks are driven by supply and demand. Cryptocurrency is only worth what investors are willing to pay for it. That being said, let's quickly head to a different crypto trading strategy that's essential in our daily lives as cryptocurrency traders. When it comes to buying and selling cryptocurrency, crypto trading strategies are definitely split into two: active trading and passive trading. Active trading is when you buy and sell assets in order to generate profit based on short-term price movements. By contrast, a passive trading strategy involves buying crypto assets and holding onto those assets for a longer period of time, adding to the value of your portfolio as your crypto assets increase in worth. But as always, there's a bit more to it than that. To help give you an idea, let's explore some effective active and passive crypto trading strategies. To make this easy, let's start with active trading strategies. Well, number one is arbitrage. Crypto arbitrage is a strategy in which investors capitalize on fairly small price discrepancies between an asset across different markets and exchanges. They look to buy cryptocurrency on one exchange and sell it on another at a higher price. Alternately, for shorts, they sell on one exchange and buy on another to close the position. Speed is crucial in crypto arbitrage trading, so automated tools are frequently used to swiftly seize arbitrage opportunities across exchanges. To fully optimize returns, keeping trading costs low is vital given the large volumes of transactions. Coming next on our list today for active trading strategies is high-frequency trading, also referred to as systematic trading. High-frequency trading is driven by automated mathematical algorithms that execute the orders in fractions of a second based on preset criteria. These algorithms manage high volumes of orders, aiming to capitalize on minute price movements over extremely short time frames, say often merely seconds or fractions of a second. The lightning-fast speed of HFT necessitates the use of trading bots. By handling substantial order sizes, high-frequency traders contribute to the liquidity of the cryptocurrency market. The primary objective here is to optimize speed and minimize transaction costs, prioritizing efficient execution and cost-effective transactions. The third strategy in active trading is range trading. Range trading is all about choosing a range at which you're comfortable buying and selling over a period of time. Cryptocurrency markets are constantly oscillating between trending and consolidating environments. The range is defined by levels of support and resistance, often presented by classic consolidation patterns such as rectangles or symmetrical triangles. In range trading, traders seek to enter a short position or close a long one at a resistance near the top of the range where resistance is encountered. Conversely, they may also aim to initiate a long position or close a short one near the bottom of the range around the support. Stop-loss orders are placed beyond the extremes of the range to mitigate risk or adverse price movements. For example, let's say you bought Cardano coin for $3,000 and you're thinking that it's going to rise by $200 by the end of the week. You then commit to a range of $3,000 to $3,200 and later resale the coin back to the exchange while its value remains within that range. The next trading strategy is scalping. Scalping is by far a common active trading strategy used by most traders in the crypto market because it's simple. You see, scalpers capitalize on short and rapid price movements, often utilizing automated bots to increase trade frequency in order to profit from tiny price fluctuations through resale. Compared to longer time frames, scalping involves higher frequency, larger trading volumes, and bigger positions, as the targeted price changes are relatively smaller. Consequently, it is essential to consider trading costs, as they can consume a significant portion of your revenue as a trader. Scalping can be risky, as reliable patterns become more difficult to identify and exploit within a shorter time frame. Therefore, you need to adhere to a strict exit strategy, ensuring that a single substantial loss does not negate the multiple small gains achieved. Scalping can be approached in two ways. The first approach involves executing many trades at high volumes to capitalize on concise and fast price movements. The second approach adopts a slower trading process relative to high-frequency scalping and focuses on slightly larger but still relatively small price movements, a lower number of trades, smaller position sizing, and slightly longer holding periods. The last trading strategy under active trading is bot trading. And just like arbitrage trading, bot trading relies on automated computer programs or trading bots to buy or sell crypto positions to get profits. The key difference is that arbitrage trading focuses primarily on the difference in prices from exchange to exchange, while bot trading looks at a variety of other factors, including the trading volumes, time periods you're looking at, historical trends, and more. That being enough about active trading strategies, let's now proceed to passive ones. One thing about passive trading strategies is that it's used by crypto investors who are in for the long haul. Passive investors don't stress over short-term market movements or scramble to shift positions based on small price differences. The three most common passive crypto strategies are buy and hold, dollar cost averaging, and finally, crypto index investing. For buy and hold, you'll buy a crypto asset, put it into storage, and let it sit in your wallet for a long period of time. The idea here is that your asset will increase in value over time without you having to take any action. As a result, the overall value of your portfolio will go up alongside those asset values. Crypto index investing, on the other hand, is a lot like investing in a traditional index fund that tracks securities like stocks. Crypto index uses a pool of funds from investors to create a unique portfolio that tracks cryptocurrencies. When the index is actively managed by professionals, index investors don't have to take any actions themselves, and that's what makes crypto index investing strategy a passive trading strategy. Lastly, we have the dollar cost averaging strategy. Dollar cost averaging is when you take on crypto positions by investing equal amounts of fiat currency at regular intervals, regardless of what the asset is priced at or what's happening in crypto markets. The idea here is simple. When prices are down, you can benefit on taking a higher volume of assets. When prices bounce back over time, you'll then have made a nice gain without a lot of effort. And just a small message to you guys. There is no universally superior trading strategy, as each trader is unique and needs to select a strategy that aligns with their understanding and comfort level. So you can definitely choose what suits you best from the ones we've talked about in this video. I hope you enjoyed our video, guys. Don't forget to send us those likes if you loved watching this. Remember to also support our work by subscribing to this channel and hitting the notification bell so you aren't left out when we release a new video. With that, here marks the end of our video today. Thanks for watching, and let's meet in our next video. Bye.